In this presentation, we will enter a bank reconciliation for the first month of operations or the first month that we have entered data into the system within QuickBooks Online. Note that as we consider the bank reconciliation process, we do want to separate that first month bank reconciliation that we do, or the first time that we reconcile, because we might run into different problems for that first reconciliation than we will in following reconciliations. So we'll do two reconciliations in a row, one bank reconciliation for the first time that we have done one within our new QuickBooks system, and we'll think about that beginning balance, which is usually the main problem, and any kind of outstanding checks that might have been there from the prior time period. And then we'll think about the second bank reconciliation later, and that will have its own problems, but typically be easier because we won't have an issue of the beginning balance not reconciling or having some kind of problems with outstanding checks that aren't currently in the system, because it's the first time that we've started reconciling within the current QuickBooks system. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We are in our Get Great Guitars file. We're going to go to the bank reconciliation. We will do that down on the left side. We're going to go to the accounting on the left side and up to the tab. You're probably on the chart of accounts. We want to go to the reconciling tab. Now, before we get into the reconciling process, just an overview of the reconciling process, what it is not, what it does for us. What it is a huge internal control. The double entry accounting system itself is done by the system, meaning QuickBooks won't let us enter something that's out of balance. That's the biggest internal control. QuickBooks itself forcing us to enter transactions that are in a balancing system. That is a huge internal control. The second internal control that we can do, both large companies and small companies should do, is going to be the bank reconciliation. It's the second biggest internal control other than the double entry accounting system that every company can do. So we do want to do that. Why is it the second biggest internal control? Why is it important? One way to think about that is to consider it by cycle. If we select this item up top and look at the cycles, we have the revenue cycle or the customer cycle, the vendor cycle or the accounts payable or purchases cycle, the employee cycle. As we go through any cycle, the revenue cycle, typically we think of revenue and cash being the major components. We invoice, goes through accounts receivable, then we receive payments. And in that cycle, cash is of course relevant. Cash is there. If we go to the vendor cycle, we're going to have expenses. We might just enter the checks, or we might enter the bill and then write the checks. Whatever that system is, cash will be relevant there, of course. And when we process the payroll, cash will at some point be relevant. So in other words, no matter what cycle we're talking about or testing, cash is going to be involved at some point, at some time. So if we can reconcile and get a better check on cash, we're also, in a way, checking the other side of the transaction, because every transaction has at least two components. The checking account, if we check the checking account, we know the transactions are entered there. We know that the other side must be entered somewhere, and therefore it's going to be a check on the other side as well. How do we reconcile cash, and why is it such a big, important reconciliation? It's really important and really easy to do because the bank has a separate record of our books on a cash basis, in essence, through the bank statement. So everything's going to go through cash at some point. All the cycles are going through cash at some point. The timing difference might be different in terms of when does it clear the bank versus when should we recognize revenue and expenses on the income statement. But it should clear the bank. Everything basically goes through cash. Most things go through cash at some point. So if we can reconcile cash, we should be good. Now the bank statement, of course, means this is going to be our mock bank statement, that they're tracking our cash for us on their side, and they're a third party outside of our business. So if we can check our books to their books, then we have a good idea of what's going on in our books, or verifying at least that we have entered all the transactions. In other words, if we can go to the bank and say, hey, is all this stuff that we entered on our side also things that have cleared the bank? If they are, then we have a second verification from two people, two institutions that are not related, and that's a very high level kind of check. Plus the bank, theoretically, is very reliable. So our goal here isn't just to see if there's an error in the bank and fix the error. That's one goal, not the primary goal. Our goal really is to double check our books to a very stable, hopefully secure, hopefully correct system, the bank, and in so doing be more secure that our books are indeed correct. So what we'll do is we'll take our mock bank statement to do that, and in essence just tick and tie out the information to make sure that we're doing things correctly. Also note that a bank reconciliation is not simply tying out to the bank. In other words, if we just download the data from the bank, as we can do, connecting to the bank, using the bank to enter our data, that's great, and we'd still want to reconcile. But notice that our books should be separate from the bank's books. So whether we download the bank information to help us with the data input or not, it's actually a better internal control if we're not doing that, because what should be happening is we're entering the data on one end and we're using the bank as a check, a safeguard, a check against it. Therefore, we really want the data input to be happening on two different levels. We do the data input, the bank does the data input, and then we check to see if they're correct. And if they're correct by two separate people doing separate data input, then that's a good verification. If we get the information directly from the bank and we run on a cash basis, that's great, and that could simplify the system, make things easier in some ways, and we'll talk a little bit about the bank feeds and how to do the bank feeds, but we still need to do the reconciliation in that case, and just note that that's not the same thing as a bank reconciliation, and if we're getting all of our information simply from the bank and just running on a cash basis from the bank instead of an accrual basis full accounting process, that might be good to do in certain cases, but it also kind of takes away from some of the assurance on the bank reconciliation, because now we don't have two people independently entering the banking information. We have just a complete reliance on the bank information, and therefore it should be reliable. Hopefully that's good, but it's not that double check. It's not the same kind of double check that we would have if we enter the information in and then the bank enters the information in. So if we do have a bank feed, if we get the information directly from the bank, if we tie to the bank and we download our transactions, we're still going to have to, one, tie those transactions out and allocate them to the proper areas, the proper expense accounts. We'll still need to know kind of what forms are, what are checks, what are forms, what are deposits, because those are the things QuickBooks is going to use to take those feeds from the bank and allocate them out. We're going to have to know how to basically do that. And we're still going to need to reconcile just to make sure that that's a double check that the data input that we have put into the system does tie out to the input from the bank. In other words, that we don't have duplicate informations, duplicate transactions, or transactions that we haven't picked up at all. So that's just going to be some of the overview from the bank reconciliation. Now, as we enter the bank reconciliation, the first bank reconciliation will be a bit more difficult in some ways than later bank reconciliations, because we have to tie out that beginning balance. The basic idea of the bank reconciliation is we're going to get the bank statement from the bank. This is going to be our mock bank statement. So this is in Excel, but it's going to be a mock bank statement. And we're just going to tick and tie out everything from the bank statement to our books. Note that even if you have online banking or something like that, you really want the statement, because the statement's going to have a very defined cutoff, which is what we want. We want to say, I'm reconciling for the month ended January 31st. And by doing that, we can say, how do we match up to the book as of this date? Does our number match up to the bank statement number? It never will, typically, because of outstanding checks. If we're doing two sets of books, meaning there's always going to be a timing difference. And our goal is to see exactly what that timing difference is, and in so doing, be confident that we tie out exactly to the bank. We know exactly what the difference is. Therefore, we know everything that's in the system is correct, and it's duplicated in the bank, two separate systems doing the same thing. That means that's a separate verification that we're doing things correctly. So that's what we're going to do. Here's the bank statement. We're going to go into our books and just tick and tie everything off, and as we do so, we'll have a separate outside verification that everything is correct. So to take a look at that further, let's go to the reports. We're going to go to the reports on the left side. We're going to open up our balance sheet, our favorite report, and we're going to scroll up top and change the dates from 01/01/19 to 01/31/19. So January through January 31st, the 1st through the 31st, 2019, and run that report. You can see in the checking account, we've got $94,436.17. And that then, as of this date, January 31st, should match the bank statement as of that date, we would think. If we go to the bank statement, we're going to say that the bank statement balance as of that date is $109,415. It doesn't match. There's a problem. It's not lining up. Now, that's the case all the time, typically, because of outstanding checks, outstanding balances. That's what we're trying to reconcile. That's what we will be reconciling. The bank statement, as we've probably seen, will be typically in a summary something like this, where we have the beginning balance, any additions, deposits, subtractions, checks, other withdrawals, fees, and that'll give us the ending balance. So beginning balance plus additions minus withdrawals, ending balance. Then we have the details. This is the detail of the additions. This plus this plus this plus this is the 136, 128, 136, 128. And then the withdrawals, the checks, or any other withdrawal, if you don't have a lot of checks and you do automatic transfers or something like that, same kind of idea. We just won't have the added benefit of the check number. And then we'll have the withdrawals and the bank service fees or any other kind of decreases. And that'll give us the total decrease. That's going to be our design, our layout of the bank statement. So our goal then is to say, why doesn't this tie out to what we saw on the balance sheet as of the same point in time? And the reason is going to be because of outstanding checks. That's what we assume. We expect that to be the case. In other words, we wrote checks, if we go into this checking account, that are close to the end of the time period, like these two payroll checks. They may not have cleared. Our employee would have had to go to the bank, deposit it, and then the bank would have had to clear it, and then tell the other bank, whatever bank they go to, and then it would have to clear. That's going to take a few days. That could take weeks. That could take a month. So this might be outstanding for a while. Our books are correct because we know we wrote the check. We know that it's going to go down eventually. But the bank doesn't know. They're not wrong. They just don't know yet. So it's a timing difference. The same could happen on deposits. We could make a deposit towards the end of the time period that hasn't yet cleared. Now, the deposit should clear pretty quick, within like a day to 3 days. So it's not as much of an issue of a timing difference, but there could be some. The checks will typically be timing differences for sure. So if we're doing a system properly, we expect our book balance to not match the bank balance at any given time, because our balance should be more accurate in that it should have the checks that we've written that haven't yet cleared in the system. So the bottom line of this is we'll tick and tie this out. If anything is on the bank statement that's not on our books, it's probably the case that the bank is right, and we'll have to add it to our books. In other words, if there was some kind of thing down here like the charges we'll see on the bank that aren't on our books, well, we're going to have to add it to our books. Our books are wrong. We'll have to fix that because they charged us $15. We're just going to have to accept that and put it into our books. If there's something on our books in QuickBooks, not on the bank statement, then it's probably a reconciling item, a timing difference. We're probably okay. We're not going to do anything. We're just going to say that that's going to be part of the difference, part of the reconciling item, part of the outstanding checks that have not cleared the bank as of the bank date, as of the 31st in this case. So let's start to go through this, and we'll just start the beginning balance here. So we're going to go back to our QuickBooks. We're going to go to the Accounting tab on the bottom left, and if we go to the Reconcile tab up top, now if you've never reconciled, you'll have this little item here. We're going to go to the Reconcile and Account. So we want to go to Reconcile and Account. We're going to go to Let's Do It, and here is our reconciliation page, our introduction page. We have the account, typically going to be the checking account. If you have more than one bank account, then you could select the separate bank accounts. You might have a bank account for the payroll, a checking account, maybe a savings account. We're going to scroll down, and then the beginning balance, this is the tricky thing. We put the beginning balance, which is correct. If we look at our bank statement then, the beginning balance is $25,000. Now that's correct because we entered the beginning balance into the system as we set up the checking account, meaning it was our first month of operations, but we already had the checking account running. We put that beginning balance in as of that time. If we didn't do that, if we didn't set up the checking account and put that beginning balance in, then in our system on the first month, this number would be 0. It would be 0, and we would actually, on the bank statement, it should be 25,000 in our case. So what if that was the case? There's a couple ways you can fix that. You could go into the beginning balance and enter it in there, or you can enter it just directly into the register at this point in time. If you go back in and this number wasn't there and it's your first time reconciling, then you can go into the register and go into the register before the time period that we're working in, meaning in this case we're doing 2019. You want to be in there at December 2018. In the register, increase the checking account by that beginning balance and put the other side to equity, most likely equity account. You could put it to an income account if you want to. It'll roll into equity anyways as of the year we are working in this case 2019. And then it still won't show up at the beginning balance, but we can just check it off as a deposit in the first bank reconciliation and note that that's what we needed to do just to get the first reconciliation going, to put that beginning balance and make it cleared, and you'll still be able to reconcile, and then everything will be good going forward. So that's the first thing to note. If you have some issues with the first bank reconciliation, that's the first issue that will typically be had. Then we're going to need the ending balance. So the ending balance, if we go back to our statement, is this 109,415. So we'll go back to QuickBooks and we'll input the 109,415. And then the date of the reconciliation is going to be the end of the month, 01/31/19. And again, you don't really want to reconcile, like, you can check your bank account and see real time the transactions that happen, but you need a cutoff, a hard cutoff to reconcile. And so that's why the bank statements are the way to go. So you don't want to just get the online data and see the running balance. That's usually not good enough. You want the statement to have a hard starting point, hard ending point, so that you can then see your cutoffs, and that's how you're going to reconcile as of a certain point in time. And then if we scroll down, we've got the enter service charges. These are going to be items like if we go to the bank statement, we see service charges here. These are items that are probably not in our system yet. And QuickBooks is saying, well, we haven't recorded them because we wouldn't know about them until we got the bank statement. So we might want to enter them right here and now. I don't typically do this, however, because when you do that, then they don't always show up on the bank reconciliation in the same way to be able to check them off, which can actually be a little confusing. So if your reconciliation, in other words, doesn't work and these things are in place, they can kind of throw you off. I want to be able to see everything that I check off within the bank reconciliation. So I typically don't use these unless I go into it first and then go back into it later and then check them off. But in essence, it'll create a journal entry. So it's going to say, if I put the 15 there, it's going to make a journal entry increasing this account, the bank charges, an expense account, and decreasing the cash account. So that's where we'll start next time. We're going to reconcile this and then actually go through the computerized reconciliation process, ticking and tying out from QuickBooks to the bank statement for the first month. For more accounting information and accounting courses, visit our website at accountinginstruction.info.